Stop scrolling. Look at your bank statement. That $500 charge you thought was a business write-off just killed your dream of owning a home. You think you're winning the tax game, but you're actually committing financial suicide. I'm going to show you exactly how the banking system uses your own tax returns as a weapon against you, and the one $500 mistake that flags you as a high-risk liability before a human even looks at your file. Being self-employed in America is supposed to be the ultimate flex. You're the CEO, the founder, the hustler. But when you walk into a lender's office, you aren't a hero. You're a ghost. You've spent all year listening to tax gurus telling you to write off every meal, every mile, and every MacBook. You've lowered your taxable income to almost zero. You think you're smart because you didn't give Uncle Sam a dime. But here's the cold, hard truth. If you tell the IRS you made no money, the bank believes you. You're living a double life. You have a six-figure lifestyle and a poverty-level tax return. The bank doesn't care about your gross revenue. They don't care about your Instagram aesthetic. They care about net bottom line stability. When you deduct that $500 miscellaneous equipment expense that was actually a weekend getaway, you didn't save $150 in taxes. You lost $150,000 in purchasing power. Let's talk about Mike. Mike's a freelance dev making $120K. He's got the truck, the gear, the office. On paper, after optimizing his taxes, he shows $22,000 in net profit. Mike goes to buy a crib in the suburbs. The loan officer laughs him out of the building. Why? Because according to his math, Mike makes less than a fast food manager. Here is the brutal reality that will make most of you lose your minds. If you aren't paying at least $20,000 a year in taxes, you don't deserve a mortgage. I know. It hurts. You want the loopholes in the house. You can't have both. You are literally paying for your own rejection. If you're triggered by that, good. Go ahead and flame me in the comments. But while you're typing, the guys who actually understand debt-to-income ratios are closing on their third investment property. Before we dive into the lender-ready framework, hit that like button and subscribe. If you don't, the algorithm will keep feeding you passive income lies while your credit score rots. You need this data. Don't let the feed bury it. To get approved, you need to follow the 2-4-month rule. Step 1. Stop the aggressive deduction cycle immediately. For 2 years, you have to eat the tax bill. It's a fee for entry. Step 2. Categorize every dollar. Banks flag uncategorized or cash expenses over $500 as red flags for money laundering or unstable lifestyle habits. Step 3. The 1,099 standard. You need to show a consistent upward trend. If you made $100K last year but $80K this year, you are a falling knife. Banks won't catch you. This isn't just about a house. It's about the psychological trap of the small business mindset. You're playing small ball. You're chasing pennies while the gatekeepers of real wealth are locking the doors. You've been told that debt is bad and write-offs are good. That is a lie designed to keep you in the middle class. Real wealth is built on leverage, and you can't leverage a lie. You have to decide today. Do you want to look rich to the IRS or actually be wealthy in the eyes of the bank? Most of you will keep hiding your income and keep wondering why you're still renting at 35. But for the few who get it, the game changes now. The banks have a blacklist of specific expense codes that trigger an automatic internal audit of your debt-to-income ratio. If you want to know the 3 specific codes that are getting you declined in 2026, you need to see what happens when your debt-to-income ratio crosses the 43% threshold. But that's a secret for the next breakdown.